The modern economy doesn't run on money the way history books taught you. It runs on collateral, credit plumbing, and forced flows, and that's why gold and the dollar can rise together without breaking the rules. The conflict is that most commentary still talks like it's 1925. Cash in, cash out, gold up means dollar down, end of story. But the machine underneath is not that machine anymore. And the moment you see the hidden mechanism, you stop getting emotionally whipsawed by headlines and you start watching the real pressure points. Stay with me, because later in this video, you're going to get a clean next week roadmap with the specific levels that matter, what would confirm the setup, what would invalidate it, and the one plumbing signal that tends to move before price does. And that's where the real edge starts. 100 years ago, the dollar was a domestic promise in a more contained banking world, and the constraint was physical. Gold reserves, convertibility, the fear of the bank run. You didn't need a philosophy degree to understand the chain. Deposits were claims, gold was the anchor, and if confidence cracked, people demanded metal. In that world, the relationship between gold and the currency felt almost mechanical, because it was. If currency was tied to gold, the gold price was a statement about the currency's credibility, and the system's limits were literal, how much gold sat in vaults. But that's not the part that matters now. The next detail is what flips the whole setup. Today, the dollar is less a currency and more the planet's primary funding rail. It is the unit trade is priced in, debt is serviced in, derivatives are margined in, and collateral is posted in. And crucially, a massive amount of dollars are not pieces of paper printed in Washington. They are balance sheet entries created through bank credit. Repo agreements, FX swaps, and offshore lending that behaves like dollars because the contracts settle in dollars. That is why staring at a dollar index and thinking you're re-staring at dollar conditions is like staring at a thermometer and thinking you've raked seeing the whole human body. The price of the dollar can drift while the availability of dollars tightens like a vice. That sounds abstract until you see how markets actually break. And that's where the real pressure starts. Here's the hidden detail that reframes everything. In the modern system, dollar stress often shows up first as collateral stress, not in the headline CPI print, not in a politician's speech. In collateral, the machine runs on high quality collateral because collateral is what turns leverage on or off. Collateral is what turns risk appetite into forced selling or forced buying. And when high quality collateral gets scarce or when balance sheets get constrained, the system tightens, even if the macro narrative says everything is fine. That is why the most important question in modern markets is not, is money being printed? It's, is the plumbing lubricated or is it seizing? Because if the plumbing seizes, the market doesn't care that your thesis is correct. It cares that somebody, somewhere, has to meet a margin call by the close. But that's not the part most people watch. Now, layer gold into that framework and the old textbook inverse correlation story starts to look like a cartoon. Gold is still sensitive to real purchasing power. If real yields fall, gold breathes easier. If inflation expectations rise while rates lag, gold tends to perk up. That's the classic non-yielding asset math, and it still matters. But gold today is also responding to credibility risk, reserve behavior, and funding market pressure, forces that weren't the dominant drivers a century ago. The market has evolved, the participants have evolved, and the incentives have evolved. And once incentives change, correlations can die quietly, then shock everyone loudly. Look at where we are right now. The next detail is, to understand modern gold, you have to separate paper price discovery from physical stress signals. The headline you see is typically a spot price derived through a complex web of futures, forwards, and OTC flows. But the physical market has its own language, premiums, availability, delivery demand, and the spreads that connect paper promises to metal in hand. When physical demand is calm and inventory is abundant, paper can dominate and the market behaves like a liquid financial asset. When physical demand tightens and inventory becomes a constraint, the market starts talking through spreads and term structure, not just spot. And when those spreads start screaming, the chart usually follows. That's not the part that gets televised, but it's the part that tends to matter first. Let's talk term structure in plain English. Gold is typically a carry market. That means futures prices often trade slightly above spot because holding gold has storage and financing costs, and because in a functioning system you can borrow gold, sell it, invest the dollars, and lock in a spread. When everything is smooth, the curve slopes upward in a gentle contango. When something changes, when the cost of financing jumps, when physical availability tightens, when demand for immediate metal rises, the curve can flatten. Nearby spreads can tighten. In extreme cases, you can even see backwardation at the front end, where near contracts price above farther contracts, which is the market's way of saying metal now is more valuable than paper later. You don't need to worship that signal. You just need to respect it because it's a window into the machine, and that's where the real pressure starts. Now, inventories. Most people hear inventory and picture a warehouse full of bars like a movie vault. The market doesn't care about inventory in theory. It cares about deliverable inventory. It cares about what can actually settle a contract, meet a delivery obligation, or satisfy a refiner's needs within the required specs and time. The difference between it exists somewhere and it is deliverable right now is the difference between calm carry and sudden scramble. In some systems, a bar can sit in a vault and be counted as inventory, but not be committed to delivery. It's eligible. It's not registered for delivery. That distinction matters because deliverable supply is what prevents a squeeze when demand shows up with urgency, and that's where the pressure starts. Now add global arbitrage, because gold is not just a US chart. Gold is a global commodity with regional price signals and logistics. If premiums rise in one region, due to strong retail demand, import constraints, or currency dynamics, arbitrage becomes a magnet pulling metal across borders. That arbitrage is not instantaneous. Bars come in different sizes. Refiners convert 400-ounce bars into kilobars. Shipping takes time. Assay takes time. And those frictions create delays. Delays are where premiums can persist, and where the physical market can whisper tightness, even while the paper market looks tame. You want proof this matters? Look at how often physical premiums and bar and coin behavior in major consuming countries shift before the broader narrative catches up. Because if physical demand is steady at elevated prices, it's telling you something about motives. And motives matter. One of the clearest street-level symptoms of this year's AS regime is the way consumer and investor behavior in big gold markets has shifted under the weight of record prices. When jewelry demand gets price-sensitive, people don't necessarily stop buying gold, they change the form. Bars, coins, ETFs, lower carat jewelry, lighter pieces. That shift is not just cultural trivia. It changes the flow dynamics. It routes demand through different channels that can be more directly linked to investment behavior and liquidity preferences. It also tells you gold is being treated less as decoration and more as a financial instrument, a store of value choice in real time. And that's where the pressure starts. Now, institutional flows. Retail loves to imagine that the gold market is just speculators. It isn't. A major underappreciated driver in recent years has been central bank and sovereign reserve behavior. Reserve managers aren't trading your RSI indicator. They're managing regime risk. They care about diversification, liquidity under stress, sanctions risk, and credibility. Surveys and commentary from the central bank community have consistently pointed to expectations of rising gold allocations and, importantly, expectations that the dollar's share in reserves may drift lower over a multi-year horizon. You don't have to make that political. It's risk management. If your job is to make sure your country can settle trade, defend credibility, and survive shocks, you don't want all your eggs in one basket. That's the mindset. And when that mindset becomes widespread, it creates a persistent bid that behaves differently from hot money. ETF flows can reverse. Central bank buying is slow, strategic, and sticky. That changes the floor under the market. But that's not the part that headlines emphasize, because it's not a one-day story. Now connect this back to the dollar. If the dollar is the world's funding rail, you can have moments where the dollar strengthens because funding demand spikes, even while the longer-term narrative is dollar weakening. Those are not contradictory statements. They are different layers. The dollar's exchange rate is a relative price across a basket of currencies. Dollar funding stress is about the availability and cost of dollar balance sheet capacity in the plumbing, FX swaps, repo, dealer intermediation, and the willingness of institutions to extend credit. When stress rises, the system grabs for collateral and cash-like instruments that can support the dollar in bursts. At the same time, the same stress can increase the appeal of gold as a hedge against systemic credibility risk and as an asset that sits outside someone else's liability. That's how gold and the dollar can rise together. It's not a broken model. It's two different functions reacting to the same constraint. And that's where the real pressure starts. This is also why the gold is just inflation story is incomplete. Inflation is one driver, real yields are one driver. But when markets fear that the policy response to debt dynamics will involve financial repression, keeping rates below inflation, prioritizing stability over purity, gold behaves like a pressure release valve. It is not about predicting doom. It's about acknowledging incentives. Highly indebted systems prefer lower real rates over time because lower real rates make debt more manageable. That doesn't mean catastrophe tomorrow. It means the bias of the machine matters. And markets ultimately trade the bias of the machine. But that's not the part that matters most this week. The calendar is. Why now is not a mystical question. The calendar is a catalyst because markets are run by mandates, reporting dates, hedging cycles, and liquidity patterns. Year-end is when balance sheets get cleaned. Funds rebalance. Dealers manage their inventories. Risk limits tighten. Liquidity thins. And thin liquidity changes everything because in thin liquidity, forced flows move price more than opinions do. That's why you see violent moves around holidays, month end, quarter end, and year end. Not because the economy changed overnight, because the market's capacity to absorb risk changed overnight. You can watch this in real time when margin requirements are raised into a thin tape. It turns normal volatility into a chain reaction. And that's where the real pressure starts. Now, here's the part that the mainstream often denies or downplays. There are always participants with incentives for gold to be boring, not because of a comic book villain plan, but because of risk management and narrative stability. When gold is calm, it's easier for policy to project confidence. It's easier for portfolios to hold their allocations without uncomfortable questions. It's easier for volatility to stay contained. When gold moves aggressively, it forces people to look at the credibility layer of the system. It forces conversations about rates, reserves, and trust. And those conversations can feed the move because markets are reflexive. Price changes beliefs, and beliefs change flows. That doesn't require manipulation claims. It requires incentives, and incentives are enough. Now we shift gears because this is where most viewers get psychologically ambushed. The market's favorite trick is to punish correct theses with violent noise because nothing shakes out retail like a fast drawdown right before the move resumes. Gold can be in a structural uptrend and still drop 3 to 5% in days if leverage gets squeezed, if margins rise, if risk parity degrosses, or if a headline triggers a scramble for collateral. If you are sized for the trend but emotionally calibrated to the noise, you will sell the bottom and call it discipline. That's not discipline. That's being liquidity for the machine. And that's where the pressure starts. So here's the shield. Separate trend signal from noise. Trend signal is what happens on weekly and monthly closes, on breakouts and retests, on sustained changes in term structure, on persistent institutional flows, on a durable shift in real rate expectations, on observable changes in reserve behavior. Noise is intraday headline whiplash, thin liquidity spikes, and margin-driven flushes. The machine uses noise to trigger your worst instincts because humans are wired to overreact to short-term pain. When price drops fast, your brain invents a story that makes selling feel like safety. When price rises fast, your brain invents a story that makes buying feel urgent. Both instincts are exploitable. The antidote is a plan built around levels and signals, not emotions. And that's where the real edge starts. Now we get concrete, because this is where people regain control. In the near term, gold has a few obvious reference points based on where it's traded recently. Scenario 2 is the squeeze case. Price holds firm in thin liquidity, breaks back above major resistance, and accelerates because forced hedging and short covering collide with constrained liquidity. In a squeeze case, gap risk rises because liquidity can vanish and the market can jump levels without giving clean entries. That's not a prophecy, it's a map. And that's where the real edge starts. Now let's stack proof, because you should never rely on one argument. Proof point 1 is price behavior itself. An extraordinary annual move tells you demand has been deeper than a single narrative, and late year dips that coincide with margin changes tell you leverage has been part of the short-term volatility. Proof point 2 is institutional flow behavior. ETF demand and investment flows can surge when macro and policy conditions align, and that's been a notable feature of this year's metals landscape. Proof point 3 is reserve and central bank behavior. Persistent strategic buying changes the demand base and can keep dips supported in a way that's different from purely speculative cycles. Proof point 4 is term structure and spreads. When the curve flattens or nearby spreads tighten, it hints at funding and availability dynamics that spot alone can hide. Proof point 5 is physical market symptoms, shifts toward bars, coins, and investment forms in major consuming markets at high prices show that demand is not purely decorative. Yes, financial. Proof point 6 is global arbitrage. Regional premiums and logistics frictions can pull metal and tighten conditions, especially when refining and delivery constraints matter. That's a stack, not a single story, and that's why the setup is more robust than a meme correlation chart. Now, the dollar side of this is where most people get trapped. They think the dollar is up or down. The dollar is two things at once, a price and a function. The price is what you see in DXY. The function is the settlement and collateral role inside global finance. You can see the price weaken over a year while the function remains dominant and becomes more stressed at the margin during certain windows. That can create the exact environment where gold remains bid as regime insurance while the dollar still surges and bursts as funding demand spikes. If you're still trying to force gold up means dollar down, you will keep misreading the tape, and that's where the real pressure starts. So what comes next in the next week or two when attention is fragile and narratives are loud? First, watch the calendar. Year-end and early year flows can distort signals. The first sessions of January often reveal whether the late year move was window dressing or real repositioning. Second, watch key levels. If gold holds the low $4,300 and finds buyers on dips, that supports the controlled retest scenario. If it regains and clears the mid 4,500s with strength, that leans toward the squeeze scenario. Third, watch the nature of the move. In a healthy continuation, pullbacks are bought quickly, spreads remain firm, and volatility doesn't explode relative to direction. In a fragile move, you get sharp spikes, air pockets, and reversals that look like liquidity traps. Fourth, watch what would weaken or invalidate the thesis. A meaningful breakdown that fails to reclaim prior support on a weekly basis, paired with calming term structure. And easing stress signals would argue the move is cooling into consolidation rather than accelerating. That does not mean gold is over. It means the time horizon shifts. And time horizon is the difference between being right and getting wrecked. Now, the one metric that reframes everything, because if you only watch one thing, watch this. Watch the stress signal in the plumbing, not the headline story. In practice, that means watching the behavior of spreads and financing conditions that connect paper to physical and leverage to collateral. When nearby spreads tighten and financing stress rises, it's the market telling you that balance sheet capacity is being rationed. When capacity is rationed, prices can move violently because the marginal actor becomes forced. And when the marginal actor is forced, the next move is often faster than the last. That's the detail mainstream commentary misses because it's not cinematic. But it's the mechanism that makes the cinema. And that's where the real pressure starts. Let's bring it home with a disciplined two-scenario lens you can actually use. Scenario one is the controlled pullback and retest. In this scenario, gold chops, maybe dips, shakes out leverage, and then reclaims levels with steadier breadth. Confirmation looks like dip buying that holds structure, calmer intraday extremes, and a return of demand on retests rather than euphoric spikes. Risk in this scenario is boredom and impatience. People chase, then get chopped. Scenario two is the continuation squeeze and gap risk scenario. In this scenario, gold pushes back into and through major resistance while liquidity is thin, and hedging mechanics amplify the move. Confirmation looks like clean breaks, shallow pullbacks, and acceleration that feels too fast, because forced flows are involved. Risk in this scenario is not just downside, it's emotional decision-making. People buy tops out of urgency, then panic on the first violent dip. Both scenarios can occur even if the longer trend is intact. The difference is how you manage exposure and expectations. And here is the reminder that keeps you credible and keeps you alive. Price can whip around violently, even if the thesis is correct. Volatility is not your enemy if you are sized for it. Volatility is your enemy if you are emotionally overexposed. The machine will use volatility to make you abandon your plan. It will spike into your fear, then reverse into your regret. If you want to be the kind of investor who survives regimes, you don't need perfect predictions. You need a framework that can absorb noise without breaking. You need to know what matters, what doesn't, and what you will do before the candle forms. And that's where the real edge starts. So if you take one message from this entire breakdown, take this. Gold and the dollar aren't tea like 100 years ago because the economy isn't tea like 100 years ago. The system is not constrained by a pile of metal the way it was. It is constrained by balance sheet capacity, collateral quality, funding conditions, and institutional incentives. Gold is not just inflation. It is also regime insurance in a world where trust, reserves, and policy bias matter. The dollar is not just strong or weak. It is the world's funding rail, and its stress shows up in the plumbing before it shows up in speeches. When you watch the plumbing, you stop being surprised by the tape. When you stop being surprised, you stop being manipulated by volatility. And that's where the real pressure starts. If you are the kind of investor who rather understand the machine than chase the headline, you're already ahead of most of the crowd. And this community is built for that mindset. Keep your eyes on the levels, keep your emotions out of the candles, and keep your attention on the mechanisms the mainstream ignores because that S, where the next big move usually starts.